On this episode, we are going to take a look at Netflix. They just reported earnings and they have reported a crazy subscriber growth for this quarter. So let's get started. Let's first start off by looking at the company's stock performance. If we're looking at the day, it pretty much ended the day flat. After hours right now, it's also sitting flat. But after this company reported the amount of subscriber growth that it grew, this company went up about 8% compared for the day. So that was pretty crazy. So let's keep on looking at this company's performance. In the past month, Netflix has returned 21%. In the past 3 months, 28%. Year to date, 34%, and in the past year, 13.6%. So this is one of the few companies that has been doing amazing throughout this whole lockdown. And it's one of the few companies still striving and producing positive investments. Next, let's take a look at this company's earnings results. But before we continue, guys, don't forget to hit that subscribe button, the thumbs up, and hit the bell. It helps the small channel out so much, and I appreciate you guys watching this video. Alright, so let's start off with earnings per share. For quarter one, GAAP earnings per share were $1.57, and Netflix missed by 7 cents, so not a huge loss. Next, revenue was $5.77 billion, which beat by 20 million, not a big beat either, but this is 27.7% higher compared to same time last year. The biggest news here though was global streaming paid membership was 182.86 million members, and it's up to about 23% compared to same times last year. And this beat guidance by about 8 million extra subscribers. So guidance was supposed to be 174 million memberships. They got up to 182.8 million. The total net addition for this quarter was 15.77 million users. And again, that was a beat by 8 million. This company was expected to add somewhere around 7 million. So it's pretty impressive the amount of numbers this company had. The only thing that really questions me, that I'm questioning right now, is how did this company beat total membership by an extra 8 million? Let me say that 8 million more members, but still missed on earnings per share. We're going to find out a little bit more throughout the episode, and hopefully we can get an answer. So in this next article, they talk about quarter two guidance given by Netflix. And one thing I respect about Netflix is that when they give you a guidance, they give you a number that they think they might reach. It's not a number that they know they will reach. And this is a big difference. There's a lot of companies out there that when they give you guidance, they give you a number that they know they're gonna beat. They lowball that number so much, and once earnings come out, they're like, "Hey, we beat our estimations by this much. We're such a great company." And I think that's just a little deceptive to investors, and it's something that leaves a bad taste in my mouth. And I'm not a huge fan of Netflix, but this is one thing that I'm really happy they do. They give you a number that they're going to try their best to beat. And to me, it shows that this company is always striving for the best. And it shows some level of transparency with the investors. Unfortunately, for this upcoming quarter two, they say that the number they're giving, which is 7.5 million, what they're expecting for quarter two, is mostly guesswork. And the reason they say guesswork is they say that a huge reason they beat their numbers this quarter was because of everything being shut down. So it drives more people to subscribing into Netflix and all these types of subscriptions. But if things start to pick up in quarter two, then less people are gonna need a Netflix subscription. And that's why they say this is mostly guesswork. This past quarter was such a crazy quarter for them, and they just don't know how quarter two is gonna be. One thing that worries me though is either 2 or 1 quarters ago, I take a look at Netflix every single quarter, and either it was 2 quarters or 1 quarter ago, this company actually missed their estimate by a huge number. I think it was supposed to be like 7 billion, and it was down to about 4 million. And that was a huge loss for them. But the main reason they said was that the previous quarter, before that quarter, they had seen such a growth in membership that it created what they call a rubber band effect. And what this rubber band effect was, just like a rubber band, first, so many subscribers came knocking through the door, pulling back that slingshot or that rubber band. And by the time this next quarter came, that rubber band was just pulling back. So not many people were subscribing and some people were unsubscribing, that it made them miss that subscription growth. And that's something that I'm worried might happen next quarter. With so many people subscribing this quarter, would we see that same rubber band effect that happened not even a year ago happen again for quarter two? So it's just something I wanted to keep in mind. Next, the company says that shows that were supposed to be released in quarter two are still going to be able to be released in quarter two because all of that filming had already happened. Pretty much now was just editing, lighting, and all the effects. So none of that is going to really affect the quarter two releases. The company does say that it does have a little bit more cash at hand this quarter, but the only reason they do have a little more extra cash at hand is because production for the for films that are supposed to be released later on has halted, so they have not to pay that salary there, right? So yes, they have a little bit more cash at hand, but it's just because they're not paying those bills that need to be paid. And this is something that I really want to really emphasize, because a lot of people, especially on Twitter, I saw a lot of people were happy that for this quarter, this company actually reported a positive cash flow from operations. And I think this is one of the first few times this company has ever done that. This company is a major money burner. And the only reason it has that positive cash flow from operations is because it has halted productions, so it has halted payments as well. But the company says for this year, this company is still expected to have a negative $1 billion of negative cash flow for this full year. But that's a lot better than the 2.5 billion it expected. But again, most of this change is because this company is halting production. So some of those payments are going to be pushed out for later on, maybe next year. All right, so next, let's take a look at this company's information, shareholder letter. And first, I'm here at the after net additions per country. I want to see where the most additions of memberships was coming from and what was their average revenue per user. So first, there's 4 regions that Netflix splits up its geographics. The first region is the biggest, and that's United States and Canada. United States and Canada make up the most amount of total paid memberships, coming at about 70 million users are from United States and Canada. The second is Europe, Middle East, and Africa. That makes up about 59 million users, so about 12 million users less than United States and Canada, and that's a lot more countries there. Next, we have Latin America and Mexico. This makes up 34.3 million users. And next, we have Asia, Pacific, and China, and this makes up about 20 million users, and it's the least out of them all. So we can see the biggest members for Netflix comes from United States, Canada, and Europe, Middle East, and Africa. Next, I wanted to take a look at how many net memberships were added this quarter. So this quarter in United States and Canada, 2.3 million users were added, and the average revenue per user is $13.09. And you're gonna see this is the one. United States and Canada is the part where they make the most money per users of $13.09. In Europe, Middle East, and Africa, they gained about 7 million users, and that's actually a huge amount. I think that's where their biggest gains come from. Out of that whole 15 million users that they grew this quarter, about 7 million come from Europe, Middle East, and Africa. This is the second average revenue per users, coming at $10.40. In Latin America and Mexico, they added 2.9 million users, and the average revenue there is $8.05. You can start seeing a nice decrease there. And then in the Asia Pacific regions, they added 3.6 million users, and they get about close to $9 per revenue per users there. All right, so now I want to take a look at this company's income statement. And unlike many other companies, I like to compare the same time last year. But this company is one that's growing such a rapid pace that instead of comparing it to same time last year, I actually just want to compare it to the previous quarter, because to me, it's the closest indication of where this company is going. So revenue was about $300 million more this quarter compared to last quarter 3 months ago. But even though revenue was only $300 million more, this company actually made an operating income of about 500 million more. So you might go like, hey, Jose, how's that possible? How did this company only make $300 million more in revenue, but actually made $500 million more in operating income? The answer is easy. The amount of cost of revenue decreased. This company spent a lot less money on marketing this year, this quarter compared to last quarter. And the only reason I could think about this company lowering down their marketing is they're just trying to preserve costs just in case things go bad. Even Netflix, right, still needs cash at hand. They need to have cash just in case they need to pay those workers as this thing continues to shut down. So I understand why this company still needs to preserve some cash at hand, and they reduce it with marketing. Marketing is usually one of the first things that gets cut off in a company's cost. Next, I want to take a look at this company's balance sheet. And if you guys watch this channel, you know that the balance sheet is my favorite thing to take a look at. I feel like you can learn so much from this document. First, let's take a look at total current assets. Compared to just last quarter, this company now is sitting about $300 million more in total current assets. Not a big difference, but it's always good to have a little more cash at hand. Where last quarter they had $6.17 billion of total current assets. This quarter they have $6.45 billion worth of current assets. Next, let's take a look at this company's total assets. Total assets, this company is sitting at $35 billion of total assets compared to $34 billion last quarter, so an increase of about $1 billion. And the biggest increase here comes from content assets. So this is pretty much just, hey, they have more IP now, so they consider those an asset. This to me though is a type of asset that can't be liquidized pretty quickly, or if it can, I don't know if it will be able to return. So for this company, I'm just truly looking at total current assets because this is a cash, an asset that I know they'll be able to provide a true dollar worth. So next, let's take a look at this company's total current liabilities. So total current liabilities for this company is sitting at $7.8 billion. This is a $1 billion increase compared to same time last year. Sorry, not same time last year, compared to a quarter ago. And the biggest changes come from the two things. Short-term debt. This company has about a $500 million debt that it needs to pay off within the 12 months. Last quarter, it had nothing. So this is one of the biggest things. And again, this is probably one of the main reasons this company has extra cash at hand. The other second thing is current content liability. This company last quarter had $4.4 billion of content liability, and content liability is money they have to pay off for either their production cost or something dealing with their content. For me, it's probably most likely have to do with production cost, and this quarter they're sitting at about 4.7 billion compared to 4.4 last quarter, so about 300 million increase there. So that's where we see that total current liabilities cost increase. Next, I want to take a look at this company's long-term debt. This company sitting, last quarter, they were sitting at $14.75 billion of long-term debt. Right now, they decreased that by about 600 million, sitting at $4.17 billion of long-term debt. But again, most of that long-term debt is actually going into that short-term debt. So, right, if you add in that short-term debt that we saw in the current liabilities back into this long-term debt, it would pretty much be even to where it was at just a quarter ago. All right, so next, let's take a look at this company's cash flow from operating activities, and let's just jump straight to the bottom. Net cash flow provided by operating activities had a positive $259 million compared to a $1.4 billion. Let me repeat that. There was a $1.4 billion loss last quarter. And you might be like, Jose, that's great. This company is doing amazing. Look at that amount of net cash flow they're able to provide. Nope, that's not, it's not really that good of a news. That's pretty much an extra So they ended up making supposedly an extra $1.6 billion compared to just a quarter ago. But a huge portion of that comes from a few places. And one of the biggest reasons here was change in content liabilities. So here, this is pretty much what this company had to pay off for its production cost and its content cost. Last quarter, they paid about $571 million. This year, it was a positive 258. So there was a change of about $700 million just right there, maybe even a little bit more. That's more of about 800, right? About $800 million difference. And that definitely helped this company push to a positive net cash flow from operations. There were a little stuff here and there that actually pushed it, but that was the biggest one. So this is something that I've never been a big fan of Netflix, is this negative cash flow from operating activities. One thing I do like though is proceeds from issuance debt. This company did not issue any new debt this quarter, which is I think pretty good. This company says right now that, hey, with the amount of cash we have, what this tells me is like, hey, this company is positive with the amount of cash they have right now. They'll be able to continue working on. All right, so next let's talk about this company's growth. So here we are on Seeking Alpha and taking a look at annual revenue estimates for this company. December 2020, this company is expected to make $24.3 billion worth of revenue. For December 2021, this company is expected to make $28.8 billion of revenue. That's almost a 20% growth in just 1 year. So that's actually pretty impressive that this company is able to produce this type of growth. And I can see why many investors are willing to pay a hefty price for this company right now. And right, it is definitely a true growth company. Revenue is growing 20%. It grew 20% this past compared to the same time last year. And we're seeing earnings per share growing. We're also seeing memberships being added at a heavy rate as well. But let's take a look at annual earnings per share for this company. For December 2021, and if you guys have been watching my channel, I like to take a look at 2 years from now earnings per share and look at that forward PE ratio. For December 2021, this company is expected to make $8.34. So that would give this company a forward PE ratio of 52.46. Now, my thoughts, that I think is a little too expensive for my taste. I mean, 52.46 forward PE ratio. I don't, especially for, yes, this company is a true growing company. We already determined that, but this company has yet to provide a positive free cash flow. This company's cash flow is, they're expected to burn about $1 billion this year and even more next year. But on the flip side of that, that right now is pretty cheap. I'm pretty sure this company is able to take out a loan at easily less than 5% interest. So for a company like this, that is pretty cheap. So it's okay. I guess people could think that it's okay for this company to just keep borrowing money so it can keep growing and growing and growing. But again, for me, this seems like a little bit too high of a price. And again, that does not mean this company is a bad investment. I think an investment can be good at any time as long as you're willing to stick it out and you believe in the fundamentals. For me, I feel like, to me, Netflix is still a little bit overpriced, especially right now with this whole thing. I do think we might see that slingshot effect happening, and we're gonna see a miss in subscriber growth either Q2 or Q3 by a nice number if we end up going back to work pretty soon. So for me, I'm a big fan of growth companies, but I'm not a fan of paying too much money for a growth company. And right now, I feel like that's what's happening here. So that's it for this episode. I hope you guys enjoy it. See you next time.